Okay, sorry guys, so the stream got disconnected, but we are back live again. So if you are watching this, look at the previous stream immediately before this, before it gets disconnected. So I will continue from where we stopped over here. So let me confirm if the stream is live. Okay, yeah, so everything looks fine over here. Let me check it out. Yep, all good. Yeah, so apologies for the interruption, and please look at the immediate previous stream for you to see what we were talking earlier. So basically, when the price came all the way down, now we were looking for the retracement, and you can see the price started retracing around 9:50 a.m. New York time. So when the price started retracing at this stage, what we are looking for is for potential opportunities and clues for us to get into a sell entry. Now when the price retrace, you can see at the bottom there the red bubbles, so that means the sellers try to push the price down, but sellers failed at this stage, and you can see the green bubbles starting to print, and that means aggressive buyers started pushing the price up in this retracement. So aggressive buyers are now heavily involved in this area during the price retracement. So because of that, we are not going to enter into a sell entry immediately, because we need to wait until the aggressive buyers back up or give up, and then we need to see clues of aggressive sellers coming into the market again after the retracement. So when the price came all the way up with the green bubbles, so now we can see at this time, when 9:59 a.m., 10 a.m. New York time, we started to see aggressive sellers coming back into the market with these red bubbles, and that area is in line with this bearish stacked imbalances what you see over here, plus with these big sellers pushing the price down. So you can see these big sellers are involved in pushing the price down. So during the price retracement, you can see the price halted in that area. Now this is our first clue of the retracement being paused, and a possibility of a possible sell entry. Okay, so because after seeing these red bubbles, that is where we were deeply in analyzing for a potential sell entry in this area. And you can see with these red bubbles, it started to print these bearish candles over here. So the bearish candles have been printed, which means that it is a sign of sellers entering into the market. So at this moment, if we look at the 5-minute chart, so let me get the 5-minute chart over here. So you can see in the 5-minute chart at this time, also the 5-minute chart at 9:50, and immediately you can see it's reacting into that area where you can see this bearish stacked imbalances. And also if I take out the big trade so that you can see the price movement clearly. So let me bring the chart again. So what you can see is I took off the big trade so that you can clearly see the bearish candle being printed. Now when this bearish candle printed with the confluences what I mentioned, you can see the delta is also negative in that moment, right? So you can see red delta. Plus you can see in the cumulative volume delta, you can see there is a bearish candle printed. So what that means is, if you look at cumulative volume delta, it was bearish, and then the retracement it was bullish. Now you can see again a black color candle in cumulative volume delta, which means bearish cumulative volume delta. So when you see bearish cumulative volume delta, that is where it supports our trade idea of a potential sell entry. So we need these extra confluences in order to figure out whether we should jump into a trade or not. So let's again look into the 5-minute chart over here. So again, the 5-minute chart is showing the similar signs where the price is reacting into this bearish stacked imbalance. So what you do now is, again you jump into the 1-minute chart. So I'll bring it over here. So looking in the 1-minute chart, I have activated the big trades again in that exact area. The reason why I took the big trades off is so that when you have the big trades, the bubbles are covering the candle, so you may not clearly see the bullish or the bearish candles. But now we are back in the 1-minute chart. So what are the other confluences for us to take this trade? Now what you can see is, in this price push down, in this price leg where the price pushed away from this range. So if I just zoom a little bit, make it smaller, you can see the price pushed strongly away from this range, away from this value area low in this area. Excuse me. So when the price pushed away from the value area low, so in this price push down, in this price leg, price swing down, what we did was we draw the volume profile. So basically using the volume profile tool, we draw. So basically using the market profile and TPO tool, once you draw the volume profile, you can see the volume areas. Now when the price retrace over here, there is a possibility where the low volume nodes act as a magnet. So you can see when we draw the volume profile for this price push down, you can see in the premium area, because we are looking for a sell entry, in the premium area you can see there are low volume nodes over here. Also you can see low volume nodes over here. So when the price retrace, we are looking into these low volume nodes because they act as a magnet for the price to attract towards them. The reason is, when a strong price is, when in a strong price push down, when you see low volume nodes, the market was not in a balance in that area. So the market was not able to fulfill all the orders. So because of that, there are pending orders remaining, and that is why in a retracement, there's those low volume nodes act as a magnet, because the market needs to bring the price back into these low volume nodes in order to fulfill the pending orders which it could not fulfill because of the strong price move. Now this is what smart money traders, hold on guys, let me bring, yep, okay, 1 second. So I need to bring this over here. Yeah, let me double check if everything is okay. Yeah, everything should be fine. So when you see this fair value gap, right, you can see in this fair value gap in this area, when you see the low volume nodes, that's where we figure out the correct fair value gap. So you can see now the price is reacting in that low volume node area. So which is also extra confluence for us to understand that the price is reacting into a seller's zone. Again, looking into the 5-minute chart. So if I bring the 1-minute chart again and you can see the price is reacting into that area. So that is where we were interested in taking the sell entry. So now when we take this sell entry, basically what we did was we placed the sell entry just below the bearish candle. So if we look over here again, if I take you again to the 5 minutes chart, because we are continuously shifting from 5 minutes to 1 minute to get the confirmation from the 5 minutes as well. So if I come back to the 1 minute chart again, you can see soon after the bearish candle printed, that's where we place a sell stop order. In this case, we place a sell stop order because we wanted the price confirmation of price going down below this bearish candle. So we place a sell stop order and so the stop loss we placed in this area. There's a reason for placing the stop loss in this area, and also the take profit we target for a 1 to 5. So I will move the price forward so you can see once we place the sell stop order, the price took our order, hit our order, and price strongly moved towards a downward direction. Excuse me. So the price strongly moved towards a downward direction. Now why did so the questions you might have is, why did we target a 1 to 5? Is there any reason for that? Plus also, why did we place a stop loss over here? Is there any reason for that? So to answer those questions, let's again look into the 5 minutes chart, and also let's move into the S&P 500 chart as well. So let me show you the same area in the 5 minute chart over here, and let me also activate this. Let me also bring the S&P 500 chart as well. Let me bring those over here. So again, going into the 1 minute chart, you can see now the S&P 500 chart correlates with Nasdaq. Excuse me. So when we take this trade, we are looking into the correlation. So we also look into the S&P 500 chart at that moment. So you can see in the S&P 500 chart, when the price pushed down in that price swing, you can see in compared to Nasdaq, S&P 500, you can see a large number of red bubbles, which means aggressive sellers push the price down from here. However, what concerns us is in the S&P 500 at the bottom of this price swing, you can see large amount of aggressive sellers trying to push the price down. However, they failed to push the price down, and when the aggressive sellers failed, and with less effort, aggressive buyers brought the price up in the retracement. Now, what concerns us is when you have large number of aggressive sellers who are not successful, right? That gives us a worry of holding the trade. If we take a trade after the retracement, we are careful of not holding a large amount of the trade size in this area where the aggressive sellers failed. Now, we notice this when we look at the S&P 500 chart. You can see the same thing in the Nasdaq chart as well. However, the bubbles are smaller in the Nasdaq chart, but if you look at the S&P 500 chart, you can see it's more visible. Now, why are we showing this to you is, now when we see that aggressive sellers failed in this area, and after the price and with less effort, when aggressive buyers bring the price to the top, and if we are taking a sell entry, the idea is we should not hold the trade for long, because when the price, if the price come down into the area where aggressive sellers failed, because the aggressive sellers failed, when the price come down into this area, there's a chance that these failed aggressive sellers will come out of their trades and their stop losses can get triggered, because when the price come near their price, when they were in a drawdown, they are most likely to exit the trade because they failed. Now, if the aggressive sellers exit the trade because they failed, there's a chance where the price could push up, shoot up. So that is why we were not looking for a bigger trade, right? Or that is why we were not holding this trade for a longer time period. So that is why we target for a quick 1 to 1.5 trade. As you can see, it was a quick 1 to 1.5 trade where we took the take profits just above the area where the aggressive sellers failed. And then the reason for placing the stop loss over here is, if you look into where the price started to push down in this area, right? Okay, so let's jump into that area and analyze that, and let me bring this part. Okay, so now in order for us to place the stop loss, what we can do is we can zoom the chart and go into the footprint chart, order flow footprint chart, and look into clues of where we could place the stop loss. So analyzing the footprint chart gives us more insights of where we could precisely place the stop loss. So now let's jump into the footprint chart. Okay, so jumping into the footprint chart, basically what I will do is, so over here in this area where the aggressive sellers push the price down, so I will zoom the chart. So when I zoom the chart, I am entering into the footprint chart. So I'm looking into that area of where the aggressive sellers push the price down. So when I zoom this area over here where the aggressive sellers push the price down, okay, so if I zoom it a little more to see what was happening in that area, you can see, okay, let me zoom a little more so you can clearly see it over here. So what I can do is, for this candle, I can, in this candle, what I can see is the aggressive sellers, the bubbles were in this price levels. So these are the price levels where the aggressive sellers has been pushing the price down, and you can see this is the bearish stacked imbalance. So in this bearish stacked imbalance, right, this is where the aggressive selling happened mostly, initiated. So when we are placing the stop loss, we look into this area, and when we see this aggressive sellers active in this area, and when we see the aggressive sellers involved in the bearish stacked imbalance, so this is the price point where we will place the stop loss. So just above this, we mark this green color horizontal line so that we can see it in the other end of the chart. So this is how we decided to place the stop loss, right? So hope this is very insightful for you guys to understand how institutional traders are placing their stop losses, and how institutional traders are analyzing the market using these concepts. So the concepts we are using is order flow, volume profile, and price action, but mainly it's order flow analysis with volume profile, and also we look into the footprint of big banks, smart money, and large institutions using, and we track them using the big trades. So even the stop loss was placed just above the aggressive sellers who and the big trades. Okay, so now let's zoom down again into where we took the trade. So in the New York session, so I'm again zooming it down. So once you zoom it down again, you will go into the candlestick chart right over here. Okay, so let me check if everything is fine. Yeah, everything is fine. I was just double checking, guys, because it's a live stream, right? So now once we notice that, right, once we see, so this is that area I zoomed and I put the green color line. So that is where you can see that we placed our stop loss over here. So that is how you determine a safe stop loss. So once you determine that stop loss over here, and as I explained earlier, we were not holding the trade for long because of, if you look at the S&P 500 chart, as I said, the failed aggressive sellers can now act as support. And as I explained earlier, because of the failed aggressive sellers and the price reaching that, it can trigger their stop losses and it can make the price to go in the upward direction. Also, you can see in the S&P 500 chart, there are bullish stacked imbalance here. So that also that also can stop the price going down. Now, due to those reasons, that is how we determine our take profit level. So now again, if I come back to the micro-mini Nasdaq index futures chart, you can see that is why we were not holding the trade for long, and that is why we positioned our take profit into this area. So if you look at some of our previous streams, live streams, and previous trade recaps, you might have seen that we don't exit the trade fully at 1 to 1.5, and you might have seen we hold the trade for longer, like the trade we took yesterday. If you looked at our yesterday stream, which we streamed for our private members, our trading community, you would have seen that we hold the trade for 1 to 1.4, right? But today we are not holding. So yesterday's trade, if I show it to you over here, let me go into the 5 minutes chart, so that's easy for me to show the yesterday's trade over here. You can see yesterday's trade we were holding, as you can see over here, for a 1 to 1.4, right? And yesterday's stream, we explained to you why we were holding the trade after taking the first take profit at 1 to 1.5 yesterday. We kept the trade running into 1 to 4 because the we saw hints in the market where the trade could go up. But today's trade, as you can see, we are not holding for that long. Today's trade we are holding just for 1 to 1.5. So the whole idea is, when you place a trade, you can't have a fixed take profit level telling, okay, it's always 1 to 1.5 or 1 to 1.2. What you have to do is you have to look at the market and you have to analyze where the buyers and sellers are. And for example, if the sellers are failing, I will, as the example of in this case, see the sellers were trying to push the price down, but they failed. So if they failed, then when the price come to that area, we also should, if we are in a sell entry, we also should exit our trades, right? So that is how we ride the trades, right? Following the footprint of large institutions, big banks, smart money, and large funds, right? So we need to follow the footprint of large players, right? So that is how we determine, okay, today's trade should be exited at 1 to 1.5. So we exit the trade once we see the price came to this level and we see the price halted in this area, in that exact area, and where we see the bullish candle started to print. That's where we exited the trade for a remarkable 1 to 1.5 winning trade. So you will see, once we exit the trade, the price started pushing up all the way, but the trade was exited at the right moment because just above this failed aggressive sellers, and we kept the trade running